Good morning. Thank you guys for joining us today. I'm Phyllis Kyle. I'm Portfolio Operations Manager here at 1900. I'm joined today by Todd Rockwell, President of 1900, Bobby Jones, Senior Vice President and Senior Investment Advisor, and Whitney Pigg, Jefferson Bank Private Banker. Today, we're going to start off with a firm update, and then Bobby's going to talk about the markets, and Whitney and I are going to cover fraud awareness and prevention. And then we'll close it out with a question and answer. Todd, would you like to get us started?
Sure. Good morning. I appreciate y'all joining us this morning. Actually, Phyllis, can you go back to the original slide, the cover slide, please? There we go. As we were preparing for the call this morning in this room, this jumped out at me, and we look at this cover slide and see there in the teal box, we focus on what matters most to you. We know that each of you place your trust in us to manage your assets, but I want to take this opportunity to address what we've all been focused on the last few days and make us focus on what really matters in our respective lives. I want to take a heartfelt moment to acknowledge the Hill Country flooding disaster. This has deeply affected our community, the state of Texas, and our nation. We discussed canceling the call here over the last couple of days, but we continue to move forward. But we all want to continue to pray for those impacted, which are the families, the first responders, and the communities. As we hear a fire truck going by right now down on Broadway. We pray for God's comfort and his peace in the journey of recovery and healing for all these families in our communities. We at 1900 and Jefferson Bank, like many of our neighbors, are doing whatever we can to help in these communities. In that effort, Jefferson Bank and 1900 have made a donation to the Community Foundation of the Texas Hill Country. We work closely with Austin Dixon and his team at the foundation there in Kerrville. And I think actually Bobby will address this a little bit later, but for those of y'all that are considering a donation, if you would like to give us a shout, we can help you be tax efficient on the donation. But clearly we know that taxes are not driving this decision. It is much deeper than just tax awareness, but know that we're here to help with you. So Phyllis, if you'll go back to the firm update, thank y'all for allowing me to share those comments with you. There we go. Thank you for joining us again this morning. I do want to give you a quick firm update. This is a picture that actually is a little bit updated because we've added 3 people since here, but since this picture was taken. As of June 30, our assets under management are $2.7 billion. We've had some growth in the first half of this year. We're excited about that. We have recently launched the 1900 Wealth Office in Boerne with the hiring of our market manager, Mary Mullins Romancic. I'll talk more about her shortly. But we currently have 24 team members at 1900 Wealth, and we're excited to have 2 interns join us for the summer. So that said, let me tell you about these new additions and the interns. First, on the left there, Charles Dodd, Vice President Investment Officer. He recently joined our portfolio management team working under Bobby. He grew up in West Virginia, majored in finance at Robert Morris University in Pittsburgh, where he received his undergrad and MBA. Since graduating, he's worked several years as a research analyst, and we're excited to have him on our portfolio management team. There in the middle, you see Terry Grubb, Senior Vice President, Director of Ops and Client Service. Terry's a direct report to me. Terry and I have actually known each other for a long time in the San Antonio investment community. And so I'm really excited to have her join the executive team. She's a great addition to the operations and brings some fantastic experience to our team. On the right, I mentioned Mary earlier, Mary Mullins Romancic. Excuse me. She joined us from Piper Sandler Investment Bank in Houston and brings a strong IB background to our team. She recently moved back to her hometown of Boerne from Houston, and she hit the ground running by, we've got a client that's going through a sizable liquidity event this year, and so she's been stewarding the process for this client. So we're excited to have her on our team. She's leading the efforts in Bernie, Kerrville, and Fredericksburg. So we're excited to have these 3 new members, and I hope you have some time to meet with them or work with them directly. Next, I want to take a couple minutes to introduce these 2 guys to you. They're great. We call them the twins here in the office because they do look like they could be brothers. In fact, their first day I walked into the office and I called Will Jack and Jack Will, so I had them mixed up, but they're great guys. Will Finken there on the left, originally from Austin, found his way to College Station as a rising senior at Texas A&M. He's pursuing a degree in finance and real estate with a minor in financial planning. He's already pounding out some great work and hopefully learning some good information along the way. There on the right, we have Jack Sawyer joining us for the summer. Many of you will remember Bill Galbraith, who is a key executive at Jefferson Bank. Jack is Bill's grandson, and we see many of Bill's signature traits in Jack. So that's great. He's an incoming junior at Texas A&M studying finance. He grew up in College Station before moving to San Antonio to attend high school at Alamo Heights. Both these guys like outdoor activities, sports, and I'm glad that they're both Aggies that have joined us for the summer. I'm a little partial to Texas A&M. So with these introductions of the 5 guys or 5 individuals, we're excited to have all of them here. And so I'll turn it back over to you, Phyllis.
Thank you, Todd. All right, and I will hand it off to Bobby.
All right. Well, good morning, everybody. We are going to start with big picture. So the first half of 2025 has been a reminder that markets don't always move in a straight line. Despite a volatile path, which has included the 3rd largest drawdown in 30 years following Liberation Day announcements, the S&P 500 still managed a solid 6.2% total return for this year, which that return is comprised of a price increase of about 5.5% and about 0.7% in paid out dividends. What's notable is how average this return looks on paper, yet how abnormal the journey has been. We saw a strong start, a sharp correction, and then a remarkable recovery, underscoring the importance of staying invested. Most of you have heard me mention that time in market is more important than timing the market, and there's no better depiction of this dynamic than the start to this year. There are a lot of smart people on television, but not a single one predicted that we would be at all-time highs by the end of June, back in April and May. Yet, here we are. In the next slide, I really want to show the magnitude of the increase in volatility that we observed in April, as it was historic in nature and uncomfortable in practice. Now, I'm sure many academics might take issue with what I'm referring to as volatility, but what I'm looking at is really the daily high-low range of the market relative to its open price. So just rough math, if the market opens at 100 and it trades from 95 to 105, that would be a $10 spread. Relative to 100 is 10%. So just to give you a sense for how I'm kind of capturing this, but what it does is it really shows the anxiety and unease that we saw post Liberation Day. So you see a modest spike in March as policy agenda began to shape up, and a dramatic increase in April after that infamous chart came out in the Rose Garden. But volatility has since moderated, suggesting markets are digesting the news and recalibrating. As of this week, we are starting to see some more uncertainty come back with regards to trade policy that could generate heightened volatility, but I'd urge you to anchor your resolve based upon our experiences this spring. One of the biggest shifts this year that we've seen so far has really been the breakdown in the momentum trade. The Mag 7, which stands for Magnificent Seven, and that just refers to 7 big tech stocks, Amazon, Apple, Google, Meta, Microsoft, Nvidia, and Tesla, drove much of the 2024's gains and significantly outperformed the rest of the S&P 500, which you can see on the left side of the left chart. But year to date, those stocks are up just under 2%, while the rest of the S&P 500 is up nearly 8% year to date. Meanwhile, international equities have finally outperformed after 7 consecutive years of underperforming domestic equities. And you can see this depiction on the right side. And year to date, that outperformance has been nearly 13%, which is pretty dramatic. This rotation suggests a very healthy broadening of market leadership and underscores the importance of diversification across sectors and geographies. Turning to fixed income, 2025 has been a banner year so far, really highlighting the strong and positive fixed income fundamentals of the market. Interest rate relief has fueled returns as first half market returns returned a balance of earned yield from the coupons of the underlying bonds themselves, as well as price appreciation from lower interest rates as the belly of the curve and longer bonds declined in yields by 50 basis points or more since January 1st. With inflation easing and a resilient economy, credit markets have performed well. High yield markets are up 4.6%, and even core bonds have delivered over 4% on a year-to-date basis. Keep in mind that as fixed income markets earn coupons, the rest of the year performance will be dictated based upon further income generation off of these investments. This performance really demonstrates the attractiveness of fixed income, and it reinforces the role of fixed income as a stabilizer in portfolios and the capability to produce income that is attractive, in my opinion, in today's market. One of the very interesting dynamics we've seen in the broader fixed income marketplace has been the underperformance and opportunity then presented with municipal bonds. The best comparison of municipal bonds, in my opinion, is to look at the difference between A-rated corporate bonds and intermediate maturity A-rated or better municipal bonds to try to understand the difference in what an investor would receive on an after-tax basis versus municipal bonds, which don't have to pay tax on their earned income. Traditionally, municipal bonds make most sense for taxpayers in the top tax bracket. That includes high-income earners as well as most irrevocable trusts. But in 2025, muni bonds sold off pretty dramatically after Liberation Day, as some market speculation took hold that President Trump might attack the tax beneficial treatment of municipal bond income. As a result, the sell-off has broadened the opportunity set for more taxpayers, and that's kind of what we're showing on these charts on the right. Municipal bonds are not a one-size-fits-all strategy. In order to assess the suitability, you really need to have a grasp of what your marginal tax bracket is. Despite the tax-free appeal, they're not for everyone. If you are below the 32% marginal tax bracket, these aren't for you. You'd be better off earning a higher yield in taxable bonds and paying the associated taxes. If fixed income is a critical component of your portfolio, you should definitely reach out to your advisor to explore the opportunity to improve your after-tax yield generation. On to the one big beautiful bill. On the policy front, the Trump administration signed major tax legislation into law on July 4th. Key changes include a permanent extension of the Tax Cut and Jobs Act brackets from 2017. Most notably, as it relates to most of the folks on this call, estate tax exemptions are now permanent and stand at $15 million per person or $30 million for a married couple, which is an increase from previous levels. And a significant increase in the SALT cap to $40,000 from $10,000. One thing I'll note is that the SALT cap benefit does phase out above $500,000 of AGI. Now, this may not seem like much at first, but for a lot of you on the call, it'll probably lead to as much as finding $10,000 in your pocket come April 15th, 2026. One novel concept embedded in the bill is the formation of Trump accounts. Details are scant, but for babies born in 2024 to 2028, there will be accounts opened in their name and funded with $1,000 per child, and the intention is to have them invested in market securities such as the stock market, not just treasury obligations. This is a pivotal change in direction for how public-sponsored benefit plans have been architected and could have material implications in the future for how to deal with programs like Social Security and Medicare. On the business front, several important pieces of legislation should propel economic development as well as pave the way for trade negotiations, as the law has provided for permanent expensing for R&D and capital improvements, including manufacturing facilities. This is an important development as it relates to trade policy, which we'll talk about right now. So trade policy is back in the spotlight. I won't spend much time here other than to say this is front and center for the administration, and we are getting news every single day about changing dynamics. On the top right screen, I really wanted to highlight the historic significance of the impact of trade policy uncertainty. This chart shows the mentions of trade policy within newspapers going back to 1985. And you can see lately how off the charts it has been. And this really underpins the market volatility we've seen. And I'll also kind of highlight, when I reached out to a lot of you in early April after we saw the impacts of Liberation Day taking hold, I think at the time I said, if we don't know anything else other than where we're going forward, it does seem that we have hit the peak of uncertainty and we should be heading down. And I'm pleased to say that that is the case. On the bottom right, there's an interesting chart that Charles has helped me prepare. And actually that's one thing, Todd mentioned Charles, but I do want to give a shout out. He's hit the ground running. He's been here less than 2 weeks and has already done some really incredible work for us so far. But one of the things that I'll leave you with is that under most scenarios, it appears that when all is said and done, the US Treasury is looking at taking in $200 to $300 billion of net new revenues, which is an important step in the right direction towards bringing down record federal deficits. And so to wrap it up, 2025 has been a year of transition, volatility, leadership, rotation, and policy shifts. But through it all, the markets have rewarded patience and diversification. Year to date, a blend of stock markets and fixed income markets have increased around 4 to 5%. Looking forward, I'm optimistic on the future direction of the market and believe we'll end the year with an S&P 500 around 6,500. If I'm right, we could see a 3 to 5% increase in risk assets through the back half of the year. But if we've learned anything from the first 6 months of the year, it's that nobody knows what's coming next, including myself. That's why I'm much more focused on what will happen over the next 30 years and not the next 6 months. With that, I'd like to turn back to the main event, and we'll have Phyllis and Whitney discuss a very important issue for you guys.
Thank you, Bob. Switching gears now to cybersecurity and fraud prevention, we are happy to have Whitney Pigg with us today. Many of you know Whitney already. She's a valued member of our private bank team at Jefferson Bank. Whitney's going to be talking about the types of fraud she's been seeing and give some advice on how we can avoid falling prey to some of those scams. Whitney?
Okay, first let's talk about an imposter. In this case, this is someone pretending to be your financial partner, either the bank, 1900, your credit card company, IRS, etc. These imposters have gotten very good at what they do. They'll call from what appears to be a Jefferson Bank phone number. They might pretend to be our fraud department, and they're going to ask you to verify recent transactions. This is tough because our fraud department does do that when we see things that don't look right on your account. However, they're going to be asking you for codes and your login information, things that we already have and we don't need you to tell us. So just be careful when you receive those calls. I'm giving you permission to hang up on Jefferson Bank and to call us back. If you receive one of these, a call, text, or email asking you to share personal information, do not do it. And I know some of this sounds a little rudimentary, but these people really are good and they catch you off guard. So drilling it in never hurts. If you get one of these calls, like I said, hang up, go to the website or a phone number that you know and call back. Don't provide any of your personal identifying information. And never read back a security code or type in a code from a text message. Remote access. This is when someone sends you a link or a text message to gain access to your devices. This may be someone pretending to be your IT firm with a software update or some type of subscription renewal. Don't ever allow anyone to have control of your computer or to remote in. Don't click on pop-up ads or attachments from unknown senders, and even known senders. Sometimes you'll get an email. If it doesn't look right, ask a question, make a call. Hang up if you get a call requesting remote computer access. And update your security software. I know no one wants to do this, It's a pain for everybody, but it's important. And back up your data regularly.
So I'll just add a little bit to what Whitney commented on. The FBI has flagged these three other scams as being prevalent currently. And pretty much everything that Whitney said for the other frauds and scams applies here also. I will add that I did read several sources that recommend for an investment that you're interested in or considering, do an internet search, but in the search include the name and as well as the word scam or complaints. And that gives you apparently some extra information. On the left-hand side of your screen, you're going to see some government websites that offer a wealth of information on recognizing fraud, what to do if you get it, just lots of information that you might find useful. And that last website, the ic3.gov, that is the FBI's Internet Crime Complaint Center, and that's kind of the hub of where you go to report cybercrime. And on the right-hand side, obviously, if you're considering charities, you want to verify them. These four websites offer in-depth information on legitimate charities. So one thing you might have noticed as we talked about fraud is there is a bit of a balancing act between convenience and risk. I mean, you'll notice the safest thing to do is often the most inconvenient thing. I mean, clearly, it takes a lot more work to not click the link, but switch off to another platform or another device to double check whatever it is you're considering doing. Obviously, we're going to recommend that you do the safest things and take that extra time. So both Jefferson Bank and 1900 have implemented some procedures to make both of us safer. So I'll let Whitney talk about what Jefferson Bank has done.
Yeah, the bank pours a lot of money and resources into keeping your funds safe, but it really does take both sides. And believe it or not, as electronic as the world is going, check fraud is on the rise. If you can avoid writing and mailing a check, I highly recommend you do that. Positive Pay is one of the systems that we have in place for commercial customers. This product helps detect unauthorized checks or electronic payments. The bank also utilizes AI software. I know AI is a little scary right now, but we're using it to our advantage in collaboration with other financial institutions. This is helping to gather intel on your checks and learn your check writing patterns to detect any anomalies. And last, while Jefferson Bank has every policy and procedure in place to protect your accounts, knowing your customer has proven to be the most effective tool in detecting and preventing fraud. When we know you, when we know your business, your family, your tone in emails, your kids, where your ranch is, all of these things help us be better equipped to detect and prevent fraud. One example I'll give is I received an email from a customer. They wanted to add a new CFO, and they gave me every single bit of information I would need to do that in one email. And me and my team immediately knew it was fraud because this customer would have never provided everything we needed in one email. So it's little things like that. We kind of laugh about the most obvious ones, but some of them are just not. So keep your head down. If anything looks weird, question it. Slow down, stay alert, and always verify. And then last, Jefferson Bank, we have an amazing fraud prevention and cybersecurity section on our website, and I highly recommend you look at that. There are all kinds of tips on there and good ideas and information.
And at 1900, we're beefing up our security also. We're initiating a passphrase for each client, and we're going to initiate dual authentication for our portal. Some of you may have already started using that. We also have verbal confirmation on all third-party wires and verbal confirmation when you're adding a signer to an account. So I'm going to close out with our top 10 recommendations on things you can do to stay safe from scams. 1, freeze your credit at all 3 credit rating bureaus. Use 2-step verification when you're logging into any websites, apps, etc. Secure your passwords, add a verbal password if you can. Add biometrics where you can, and just on that point, Schwab has now uses voice identification. Do not click on any emails, any links in emails or texts, as we mentioned before, unless you know they're 100% legit. Verbally verify disbursements. Stay current on the latest scams, which obviously you're doing because you're here today watching us. Set up account alerts. Exercise vigilance with your online presence. Make sure your privacy settings are correct and limit what you share. And finally, monitor your account activity regularly. So this concludes our presentation, and we're going to move into the question and answer portion. We did get a few. There we go. All right, so we did get a couple questions beforehand. So, Bobby, we can, see who wants to take these. The first one is, given how well the international markets have done this year, should I add to my international allocation? I think you talked about this one.
That's a great question. Yeah. Yeah, I mean, the outperformance has been pretty dramatic. I think just a few things that I would unpack there. So international's done about 18% year to date. Roughly half of that increase has been just currency related and currency driven. So I probably wouldn't expect that to continue forward. That's kind of a one-time change. And so when you actually look at international markets in their local currencies, the outperformance has been a little bit less dramatic. The other thing that I would really point back to, and we showed it in that bar chart, I glossed over it. I didn't want to spend too much time on it, but in the last decade before this year, the average year has seen domestic markets outperform by 7% per year. And when we go back in time, there really is a fine balance of really showing that domestic tends to outperform most of the time. And so from a risk reward standpoint, we like the diversification that we have. But what we recognize is that this has been kind of a year of catch up, and I don't necessarily think that it is a durable enough trend to suggest a permanent change in market structure as it relates to things like innovation, regulation, and what really drives the growth engine of our domestic supremacy. And I don't see that changing anytime soon. So, I think that it's a worthwhile conversation for everyone to have with your advisor. And but across the board, I probably wouldn't make many shifts to our long-term asset allocations as a result.
Okay, we have another one. Where do you think interest rates are going for the rest of the year? And what about the Fed? Will they lower this year or will they wait?
That's a great question, Phyllis. And if somebody could tell me, we could all make a lot of money together.
That's what I was letting you answer that one. I'll just scoot back.
No, I laugh. Look, I think the major thing that I'll point out is that the economy is really healthy right now. We're putting up anywhere from 1.5 to 2 million jobs a year. So the Fed has to really balance, full employment as well as price stability. And apart from concerns of what tariffs might do, inflation has really remained somewhat subdued. It's something that they're keeping an eye on because of the way that supply chains work and the time it takes to actually order goods from overseas and then bring them on a boat, put them on trucks, rail, get them into warehouses, inventory, and then actually push them out to consumers. So it's something that the Fed's paying attention to. But what I would say is that the economy is very resilient. Look, the market's at all-time highs, basically. And we've got interest rates in the 4 to 5% range. So really, if you look at it under that lens, there's really not a need for interest rates to come down across the board. In the face of interest rates where they are, the economy is doing great. So there's not a fundamental need for interest rates to come down. Now, the one thing that I will really highlight to everybody on the call is that if we didn't learn anything else over the last 30 days, we learned that everything that President Trump has done really is what he has kind of broadcasted and says that he wants to have done. And so because of that, while I don't truly understand exactly the tools that he may be able to deploy to bring down long-term interest rates, he has made absolutely no secret that he wants interest rates to come down. And so as a result, our fixed income portfolios are sitting with some of the longest duration that we have had in my tenure, which duration just means sensitivity to interest rates overall. So longer duration means you will benefit more when interest rates come down, and conversely could impact your returns when interest rates go up. But I think generally speaking, from a fundamental standpoint, 4 to 5% interest rates are appropriate in this economic environment. Don't see that changing, but there is the risk that there is something that the administration could do to bring interest rates down, and as a result, we're positioned to kind of win on both sides there. And then, in terms of the one thing that the Fed clearly can do is use their open market intervention tools to bring down the front end of the yield curve. Market's calling for a couple of 25 basis point decreases. Originally thought to be in the September-October timeframe, but it's looking more and more likely like July could be a live meeting. But the track record on the market to forecast what the Fed will do again is not great. So I think we're prepared to watch a couple of 25 basis point decreases this year, but we're positioned well for long-term portfolios, and we're not making any bets on what the Fed will be doing at any given meeting.
All right, so we just got a question in. Let's see. All of our
Great question.
Yeah, that is a good question. Questions: should all of our accounts, business and personal, have positive pay? The answer to that is positive pay is a business product, so it's definitely something to look into for your business accounts. Business and personal have different regulations, and there's lots of reasons for that. We don't want to go into here, but yes, for your business accounts, positive pay is a great tool to have, and I highly recommend it.
Awesome. Let's see. I think that is all the questions we have.
That's it. Yeah, thank you for joining us. One of the things that I do want to mention, Todd mentioned earlier about potential donations. Something to think about is a donor advised fund. A lot of you have them already, but it is an efficient manner as we are looking at the horrible, horrible devastation that we have seen to quickly and effectively make funds available to give should your heart feel that's the right thing to do. We use these mechanisms a lot, and it's something that I would urge you to consider as an efficient way to provide a lot of help to the many, many, many urgent needs that there are out there. But thank you for taking the time with us this morning, Phyllis. You want to close us out?
I do. Again, thank you guys for joining us this morning, and please feel free to reach out to us if you have any questions. And everybody go out there and have a good day. Bye-bye.